This meeting is being recorded.
Hi everyone, this is Roy from Lifestyle Mastery, and I'm excited to have Nik Milanović, who's a founder of This Week in Fintech, a global digest of financial technology news, and the Fintech Fund, an early stage venture capital fund. Nik was earlier working in business development and strategy at Google Finance, and he was earlier the head of strategy at Petal, and he has previously worked at Funding Circle, an online marketplace for business loans. Nik holds a BA from bachelor's from Stanford University. Welcome to the show, Nik.
Thank you, Roy. I really appreciate you having me on.
Awesome. So, I've been following your journey. I'm an avid reader of your newsletter. I've been to a couple of events here in London. Big fan of how you built a media empire, and now you're running your fund. How did your career start in finance, and what got you excited about getting to this world of fintech and startups?
Well, it's very generous of you to say media empire. I wouldn't say that we're there yet, but we have a fantastic team working together on it, and hopefully, one day we will be an empire. It's a good question. I actually, a lot of fintech people come from financial services, and normally that means, banking. But for me, I actually got my start in microfinance. And if I were going to really pretend that this is part of the master plan, I would say that that path traces back to 11th grade when I was 16 in economics class. And we watched a few movies in class about the Grameen Bank and Muhammad Yunus in Bangladesh starting up early microfinance programs. And I always thought microfinance was fascinating as a way to leverage market forces to help reduce inequality and help poor households. So I started working in microfinance, but I actually had some reservations about working for grant-funded organizations and just the dynamics of what happens when your organization is entirely dependent on grants to sustain its operations. So when I started learning more about fintech and got introduced to the co-founders at Funding Circle, I was really excited to see somebody taking the internet startup model to improving financial services for people. So I started working in fintech a little over a decade ago, and it's been exciting to see how much that space has grown since.
I think that's super interesting. I've seen you've been in that industry for such a long time, and what made you start This Week in fintech? And I also read that you reached 10,000 members as subscribers. Any advice for a podcaster like me who's still struggling to break the 10,000 subscriber mark? What's been the success for you?
Yeah, it's been really exciting to see it grow. I'm just happy that it's not only my mom reading it anymore. I actually started it as an internal newsletter just to my team because there wasn't one simple place to keep track of everything going on in fintech through a weekly update. There were a few fintech-focused publications, but none of them did a great job effectively summarizing everything that was happening in the space on a week-to-week basis. And so that's why I started it. I forwarded it to a couple friends off my team, and they said, "Hey, sign me up. I want to subscribe." And the newsletter really grew from there. It's been exciting. It's been almost 3 years of writing the newsletter now. We have 22,000 subscribers and growing. We have editor in the UK, Michael Jenkins, an editor in India, Osborne Saldana, and an editor in Mexico, Christine Chang, each of whom focus on publishing regional newsletters. And if you end up running into anybody who you think would be a good writer for an Africa-focused This Week in Fintech or a China one, we're looking to expand more.
Awesome. I've met Michael Jenkins one of some of the events in London. I think it's I've always learned a lot from him. But how did you assemble a team across in these cities, and how much time does these contributors spend on the newsletters, and are they working full time for you?
No, I'm the only person working full time on the newsletter and the business right now. But I will say, the people I just mentioned, along with, we have a 12-person team, Christina, who runs events, Michelle, who does all of our profiles, Nia, who's doing our social media, Helen, who just joined to run our podcast, and Elisa on events as well, Sophie on premium content, Mohammed on the policy edition. We have like a big team. Everybody's working part-time, but putting in a ton of time and effort onto what we're doing. And I'm just really happy that we have such a group of bright people with us to help us, put more interesting information together and create more kind of insightful products and network connections for the fintech community. So there's a lot of work that goes into keeping this going.
Interesting. And I've been, as I mentioned earlier, I've been to a couple of the events. In fact, there's an event which is happening tomorrow. But how do you go about getting sponsors for your meetups and for your newsletters? How did that go about start?
So far, all of our sponsorship interest has been inbound. We have 22,000 readers and a big enough brand that we have a lot of companies, luckily, who are interested in sponsoring us as we continue to grow, so that they can get their key messages out to the fintech community. But Alex Gillette from Rise recently just joined us part-time as our head of revenue, and he's helping us be more thoughtful about how we scale and going out and reaching out to other prospective sponsors, so that we can continue to fund the business.
Got it. And you've also started a fund, which is the Fintech Fund. What made you start it, and what's the thesis for the fund?
In isolation. So I started writing the newsletter about 3 years ago, and then started an angel investing syndicate about 2 years ago.
Okay.
And so at the 1 year mark, I kind of looked at what had gone well and what hadn't gone so well with the syndicate. What had gone really well was we were getting allocations in really competitive deals with really good fintech companies. What hadn't gone so well is that because it was a syndicate and everybody was writing out of their own pocketbooks, the check size is pretty small. So we get offered the chance to invest $100,000, and we only invest $50,000. And so that's why I started the fund as a fixed capital vehicle, but it's really focused on the same opportunities. Invest in really high quality fintech companies, very early stage, pre-seed and seed stage. And so I started working on it about a year ago, but we officially closed the fund in the beginning of this year, and have been just focused on finding great founding teams to back now.
Interesting. And are you geography agnostic, or are you only investing in US?
We are geography agnostic. There isn't necessarily a constraint or a target mix between the US and international for us. But generally, a lot of the most interesting opportunities for financial services innovation are outside of the US now. A lot of ideas in a lot of areas in the US have been kind of picked over for the last 10 years, definitely, but especially with the growth in funding for fintech companies over the last 3 years. There's a lot of competition for smaller and smaller increments of financial services. Now that won't be the case forever. We have connected to a few founding teams that we're really excited about in the US, who are finding innovative ways to tackle different problems, or to build things that are honestly wholesale new products. And so I think that there is still a lot of opportunity, but fintech has kind of hit one maturity plateau in the US, and it'll be a while before there's an opportunity to kind of scale a new innovation curve and hit the next plateau. Meanwhile, outside of the US, I think you have a lot of greenfield opportunities where you can take a model that works and cross-apply it to a local context. So, probably one of the best examples in the world is Nubank, which took the Capital One model for banking, using data to be able to effectively underwrite and differentiate consumers, and then basically cross-apply that model to Brazil, using the kind of penetration of mobile phones to offer credit and banking services to people who are unbanked in the country for the first time, and then scale that up into being a financial behemoth with a full suite of financial products, all offered online or through people's phones.
Interesting. And how do you analyze, especially when it comes to early stage startups, how do you analyze the trade of people, product, and market? What is more important to you?
So at the stage that we're investing in, which is pre-seed and seed, it's normally a founding team focused bet. Now, that's not the only signal, but it's definitely the most important set of signals. And what that means is, in all likelihood, there's not a lot of traction. We don't have much in the way of customer metrics yet. And so what we're looking at is the founding team a strong pair? Do they complement each other's skill sets and weaknesses? Do they have experience working together beforehand? Do their backgrounds and their exposure and experience match the problem that they're trying to solve? Are they familiar with the problem space? And have they specifically felt this pain point before? Is the solution that they're building the right solution? And has it been tried before? And if it was tried and it failed, why did that solution fail? And what are they doing differently to avoid the same issues? So it's a lot about the story and the vision and the founding team's fit to actually going out and building that vision and their ability to put a great team around them to do that.
Got it. And you mentioned you look at international deals as well. How do you do due diligence on startups where the team is spread across and they're remote based?
The same way that we're doing this. The majority of founders that we've backed are people that we've never actually met in person before. Mm-hmm. And that dynamic has only really been possible over the last 2 years since people got used to more and more remote meetings. And it's exciting because it means that there's, qualitatively not really much of a difference between meeting a founder remotely in the US or internationally. But we do take measures to ensure that we can quality control for geographies that we're not as familiar with. So we still run the Syndicate, which has 300 fintech people in it, to basically act as an outsourced investment committee and diligence new opportunities. We have a really broad network of people who are experts in fintech in different geographies that we can always tap when we're doing diligence. And as a rule, we don't invest in quote unquote party rounds. We don't invest if there's not a lead investor. So we'll only make an investment decision if there is a venture capital firm leading the round. And normally for international investments, this means that there has to be a local VC participating or leading the round, so that we have a point of reference that we can touch base with in order to get local context and understand kind of why they're backing this specific company.
Interesting. And Nik, you mentioned you still run a syndicate. And I tried my hands on running a syndicate, right? But I wasn't that successful. But how do you make sure that you have higher chances of closing on a syndicate deal, especially when you're doing a lot of deals in a year?
So the syndicate will invest alongside the fund itself. So the syndicate will write, one group check, and then the fund will write a check, and then we'll just end up financing the business with the aggregate amount from the fund and syndicate.
Got it. And I also realized that you have some great LPs, especially from investors and angels like Jay Gibson, who's earlier a guest on the show, as well as Sheel Menard, Shri Ramakrishnan, and some very high quality investors backing you. How do you go about building a relationship with such investors, and how do you make sure that you are able to update the investors about and the LPs about whatever deals that you're syndicating?
Luckily, a lot of our LPs are people with whom I already had a relationship, just through publishing This Week in Fintech, through working together, through being in the fintech space for a while. Jake and Sheel have been phenomenally successful with what they've built at Better Tomorrow, and I still feel like it's really early for them. So given how successful they already are, I'm excited to see how far things go. But they're both people that I consider mentors in the space, and they were very immediately supportive very early on. And so what matters to me a lot more, honestly, than just getting checks written from these LPs is really having them as mentors, having them as advocates, and having them provide a lot of support and advice as I grow this fund, because it is, definitely still a learning curve. And while I like to think that we're doing things the right way, it's mostly because we have such a great network of support system around us.
Got it. Interesting. And there's been a market meltdown, and looks like we could be heading into a recession. How do you assess what is happening in the market today, and what advice are you giving to founders on how to manage runaway and burn?
There's like a variety of analogies that I use to talk about this, and I don't know, they're all equally painful. But the one I like the most is pre-seed and seed stage investing is kind of like space exploration. If you're going to send a mission to Mars, well, it doesn't really matter if there's a storm on Mars today, because the mission is not going to arrive there for another 6 months. You need to be thinking about what the conditions are going to be like when the mission does want to land in the future, and not what conditions are like now. So it's interesting. We are in a market downturn. If it sustains, the correction will turn into a recession, and valuations started compressing in public markets, but that has trickled down quickly to late stage private, and it's now trickling down to early stage private. I think this is a fantastic thing, honestly, for the fintech space. Valuations have been growing outsized to actual performance and development for the last few years, in a way that has made a lot of companies relatively overvalued compared to kind of how far along they are. And I think it's made it really hard for people to join companies and get a compelling return on their equity. If your company is already raising at a high sticker valuation, then you as an employee aren't going to get the same kind of multiple on your equity by being an early participant as you otherwise would outside of that environment. It's also become really attractive to become a fintech founder and start a fintech company because it was a pretty sure bet over the last 2 years that you'd be able to find funding. And so I think the correction is good for both of those things because it will help us shake out some of the weaker ideas in fintech. Some of the tourist founders who created fintech companies just because they knew they would get funded will probably end up moving on to the next thing. And the result will be that they'll free up a lot of talent to join the actually promising, well-designed and principled fintech startups that are still building in this space. So I think it's going to be easier for founders to recruit higher quality talent, easier for talent to get compensated on good terms, and easier to build without the competition of having 5 fast followers immediately funded by VCs marketing against you.
Interesting to see that downturns can always have good opportunities for founders as well as employees. But what in your view is causing the massive public market drops? Is it because of the inflation rates and the interest rates going down? Is that one of the main reasons why we're seeing such a main drop?
We have been operating in a singularly low rate environment since the global financial crisis in 2008. And it's made it harder for central banks to effectively conduct monetary policy without being able to raise interest rates. And, in the case of Europe, having negative rates up until the last week for years and years. The start of the correction was really in late December when the Fed hinted that it would be raising rates 4 times this year. And I was a little bit surprised by the severity of the correction because the Fed said that they may raise rates 4 times by 25 basis points for a total of 100 bips. And if you look just like 3 or 4 years ago in 2017, the Fed rate was something like 250 bips. And so it's not like it's been that long since we've had a higher Fed rate, which was then lowered in COVID to stimulate the economy. I think it's like that plus a combination of modern monetary theory policy of printing more dollars, plus the stimulus package that we received throughout COVID, the billions and billions of dollars that were effectively printed to provide a stimulus to the economy, all of which had the natural conclusion of inflating asset prices, and asset prices everywhere. Real estate has gone up, construction materials have gone up, raw imports have gone up, the consumer price indices have all gone up, and so it's a natural result of printing money and keeping rates low. And so I think it's very important for us to have this kind of correction without creating systemic shocks in order to get the train back on the rails.
Got it. And how long do you think do you assess this downturn to happen? Is it going to be a couple of months or years? What's your assessment?
I'm just an early stage fintech investor. I don't really have any kind of special insights in the market. My speculations would probably be no better than a monkey throwing darts at this point. Fred Wilson wrote about this about a week ago, and he has much more longitudinal experience than I do, and I like his framework. He thinks that this recession most closely resembles the post-stagflation recession of the early 80s. So in the late 70s, there were price shocks in that we had inflation and constriction of oil supply through the formation of OPEC that created stagnant economic growth at the same time as high inflation, which hadn't really coincided before. Normally, high inflation corresponded with overzealous growth. And so the recession that came out of that in the early 80s pattern matches a little bit the inflation-driven consolidation of prices that we're seeing right now. And I like that model. And if you cross-apply that model, then we're probably looking at an 18-month correction that could even sustain to a 3-year correction. But it's, by all accounts, it looks like it's unlikely to be as calamitous as the 2008 global financial crisis. because this isn't really like a black swan event uncovering systemic structural issues with the global financial system. It's just, again, similar to like the dot-com boom in 2000. There was a run up in asset prices, now it's consolidating.
Got it. No, I think 80 months sounds pretty fine to me. And I want to understand, what advice would you give to founders who have offers from multi-stage funds at I'd say pre-seed or seed stage?
It's been interesting to see the competition of multi-stage funds in the pre-seed and seed space. You have many funds that the kind of like routine pattern is for funds that have public market strategies have increasingly been going private late stage and now private early stage. I think Tiger Global is probably the paradigm case of the multi-stage fund. And because their balance sheets are relatively large, it's been possible for them to invest quickly across the early stage space in fintech and other tech spaces in a way that effectively indexes the space, and it gives them a call option on taking follow-on investing with the seed rounds that they fund. But famously, they also don't take board seats. So it's really similar to a passive an active public market strategy where you're picking winners, but you're not actually getting involved with the operations of the company. It's an interesting approach. It's definitely made early stage funding more competitive. It doesn't really impact our fund because we don't lead rounds, we follow on. So we're a little bit more agnostic as to who the lead of the round is. But that strategy generally tends to work in an environment where asset prices are generally moving upwards. When there's consolidation and there's belt tightening and companies need to come back to their investors to stretch out their runway because they have high burn rates, the multi-stage funds not being there can really hurt the ability of these businesses to continue. And by kind of actively leaning out from participating in a company's operations, the multi-stage funds are generally sending the signal that they're not in the business of helping companies in workout situations. They're only available to continue picking winners, as winners emerge, given that they've already indexed the space.
Interesting. And I want to talk more about your fund. You're a first-time fund manager. What advice would you give to new first-time fund managers who are looking at raising the fund successfully? Any strategies for pitching out to LPs which work for you?
Just know that it's really like any other sales cycle, where you will have to have a large top of funnel. It's enterprise sales. The elapsed time for closing a deal is going to be longer than you expect it to be by a factor of possibly 2 to 3x. You'll need to have a lot of repeat conversations by the end of which your pitch will be very honed. And you need to think about your product's competitive differentiation because early stage venture dollars are very commoditized at this point. And you need to think about your story and why it's different from other stories, knowing that the LPs that you're talking to are probably getting pitched by many other emerging managers. If you have a strong and compelling story, though, it's just a numbers game. Keep having conversations, keep getting introductions, and eventually, if you are a good emerging manager prospect, you should be able to put a fund together. Even in this environment, I think it's easy for a lot of emerging managers to get discouraged by LP uncertainty in the market. And definitely for the next couple months, everybody's waiting to see where the bottom is before making new investing decisions. But I think this is a great time to be investing, and it's a good time to be starting those relationships up for when LPs are willing to make early stage bets again.
Interesting. And how do you look at portfolio construction with your new fund? Do you focus on a specific sector in fintech, or what's your strategy for investing into these?
Our goal is to have exposure across on the order of 35 to 45 companies out of Fund 1, so that we can manageably provide support to all the founders that we're backing. We'll invest about 70% in first rounds for companies and save about 30% in the fund for follow-on and taking our pro rata allocations.
Got it. And percentage really matter in seed stage, or what are your thoughts on ownership requirements, especially when it comes to new fund?
It's not an explicit target for us right now. What we're focused on is really aggressively canvassing the fintech space as it is, in this 12 months and finding the best teams to back. We don't have an ownership target because the fund is too small to credibly take a big piece of the business. To put an example around that, let's say we had a 1% ownership target, then we would have to write, at least a $200,000 check for every business valued at 20 million. If we had a 2% ownership target, that would need to be a $400,000 check, and we'd exhaust the fund pretty quickly. We wouldn't be able to make the same number of bets. Now that may become more relevant for Fund 2, where we start having allocation and ownership thresholds. But for Fund 1, it's more about developing a track record and finding the best teams to back.
Got it. Interesting. And Nik, you manage your fund as well as you run This Week in Fintech. How do you manage both the businesses, and what's your time management tips for people who are trying to do multiple things?
I'd say I'm still on the learning side rather than the teaching side for time management. I split my time evenly between those two efforts, but those initiatives actually really complement each other. The newsletter leads to a ton of inbound for the fund, and the fund gives us a good reason to really drill down into the most exciting innovations taking place today in the space, which makes us smarter about what's going on in fintech. I think ruthless prioritization is really important for managing and bootstrapping two things at the same time, even one thing. So what you say yes to is much less important than what you say no to. You need to be able to close off opportunities and say no to everything that is not within the narrow band of where you should be spending your time, and then prioritize with that set of activities that you should be spending time on.
Got it. And when it comes to This Week in Fintech, you run a newsletter and you also run events. Are you looking to expand your portfolio of products, especially like podcasts or other verticals across regions, or do you want to focus just on the newsletter and the events for the time?
No, we're going to be launching a lot this year. So we recently brought Helen Femi in London onto the team to run a fintech bi-weekly fintech news podcast. Wow. We're adding more people to the team as writers, both staff writers and guest writers. And we're in the process of launching an online community for fintech people that'll be coming out later this year.
Well, super interesting. Looking forward to engage with your newsletter and your events. Nik, I quickly want to do the top three. What's your favorite business book?
Favorite business book? It's interesting. This actually isn't. It's not technically a business book, but I think it is honestly one of the most instructive stories for anybody leading a team. There's a book called Team of Rivals. It's about Abraham Lincoln and how he managed his cabinet. And to put together a cabinet, he basically put together a cabinet of all the people who opposed him in multiple elections, because he knew that these are people who would not be yes men. He knew that they were the most forward-thinking individuals he could put in his cabinet at one time. And he knew that if an idea got out of the cabinet with their support, it would probably get support across the country, because they had such a high bar for Lincoln's ideas. They weren't people who innately agreed with them. I think it's a great example of management, delegation, and leadership strategy, and really how he navigated an extremely difficult situation in the Civil War. And I think it cross applies very neatly to business management.
I'm definitely going to put in the show notes. I'm also going to read it. I think Abraham Lincoln was a super smart guy, and love the story. Definitely going to give it a read. If you could go back in time when you started your newsletter and the fund, what is the one thing you would have focused on or done anything differently?
To be honest, I just wish I had started investing earlier. I spent, my first 8 years in fintech developing a lot of domain-specific expertise that I could have leveraged as an investor to make some good decisions. But I, was broke for those 8 years, so I didn't really have much in the way of capital. But if I had started angel investing earlier, I think it would have given me a much broader perspective across the field and all the innovation that was taking place in it.
Yeah, no, absolutely, super relevant. And what's your favorite online tool? For example, Gmail, Slack, Zoom.
I'm sorry, what was that?
What's your favorite online tool? For example, Gmail, Slack, Zoom.
Favorite online tool? Oh man, what do I spend all my time in? Well, I know what I spend all my time in, but it's not my favorite online tool. It's my accounting tool, and I do not want to talk about that. Honestly, well, this is going to sound a little bit like a cop-out because I worked for Google, but Google Docs is just a fantastic collaboration tool. It basically has allowed us to replace a lot of the elements of a website where we host forums for surveying people in Google Docs. We have PDFs and basically flyers and information about us all saved in publicly available Google Docs. It's really facilitated a lot of what you'd ordinarily use a website or other collaboration tools to do on Google Workspace. That's like the kind of conventional answer. One that I'll say that probably most people don't know about is UMSO, UMSO, that allows us to build lightweight landing pages, and we use that for hosting a lot of our online presence.
Oh, I've never heard about UMSO. I'm going to check that out and put that in the show notes. Nik, what is the best way people can reach out to you and know more about This Week in Fintech and the Fintech Fund?
Yeah, I'm always looking to connect with new people, especially anyone interested in fintech. So Twitter DM is definitely the place to reach me. I have open DMs and normally try to get back to people pretty quickly.
Got it. We'll put that in the show notes. Nik, thank you so much for taking your time speaking to us. I really enjoyed my conversation with you.
Yeah, Rohit, thank you for the invitation. I appreciate you having me on, and hopefully we'll get a chance to meet in London soon.